All right, welcome to Peace of Mind Radio. I am Brian Rames along with Chris Vaughn and Eric Douglas, and we got a little bit different spin today. This is actually a article that Eric picked up. So, by the way, if you don't like the conversation we're having today, you can text or email Eric.
I'll be your fall guy. Yeah, thanks.
So this is pretty interesting. So we always talk stats, and we talk, kind of the market is always repeating itself. Mm-hmm. And so this article is pretty interesting. We can give it to you. So if you want a copy of this article, and by the way, Eric's going to give credit to the guy that wrote it because I can't remember it. I think it just came out, right?
So it was an article that was published. It was actually a blog post, as a matter of fact.
Yeah.
An advisor I follow out in New York, as a matter of fact, Michael Batnick. This is a blog post that he wrote about the 20 craziest investment stats, basically.
Yeah.
And it had a lot of really good info. I want to make sure where credit is due, right?
Yeah.
So we're not stealing an idea here and trying to pass it off on our own. But these stats I thought were really, really cool, really, really interesting, and very, very relevant as well to a lot of the things that we talk about on a daily basis.
Yeah, absolutely. So the cool thing is we'll put the link or our contact information be right below this video, and if you want it, send us an email, and we will make sure that you get a copy of this. It's pretty cool. So, and then we also have another piece I think we mentioned maybe in another podcast, maybe the one before this one or the one before that. I can't remember, but it was talking about, if you've ever seen it, I think it was the one, not this past one, but the time before that. Anyway, but there's a publication that we have a copy of it here in the office that kind of does the same thing. Hopefully somebody will edit that part out.
Nope, it's in there, man.
It's like my cough 2 weeks ago. I know. But no, it was it was the Time magazine. You guys have seen it.
Yep.
That spreads out like 70 years, and it shows the covers of Time magazine, how all this drama happens.
Yep.
And the markets continue to go up. So anyway, this is kind of what we're talking about today. So what we're going to do is we're going to round robin this thing, and we'll just kind of go around the table. Chris hadn't said anything yet, so I know he's kind of itching to say something.
I'm always itching to say something.
I know. So we're going to let Chris go first, and we're just going to, again, kind of round robin it, and we're just going to put our own spin on these topics. So when we mention a bullet point that's in here, it may not necessarily reflect exactly what the author said. We're going to put our own spin on it. And so if you get the article and you say, hey, what you guys said wasn't exactly what the author said, did I say Arthur? Anyway, the reason why is because we chose to just take our own spin, our own experience, and apply it to the headlines or the topics. All right? So, Chris, why don't you go first?
So I'm going to get started. All right, let's see. So the first several that are on this list I thought were all pretty similar. So it's the first one says, since 1916, the Dow, so that's the Dow Jones Industrial Average, has made new all-time highs less than 5% of all days. But it's up 25,568% over that same time. And I think that's one of those things that we've seen so much on the news lately, a new all-time high, because it's been skyrocketing over the last few years. But most days, you're not hitting that all-time high. It's dropping back down. It's that constant fluctuation. And it even says on here, 95% of the time you're underwater. The less you look, the better off you'll be. And that's something that I've talked to clients many times about is if you are staring at your investments all day long, every day, if you're constantly checking it, you are probably causing yourself a lot of stress that there's not much you can do about. A good portfolio is designed for those ups and downs, right?
Well, yeah, and I'll make a comment on that.
Yeah,
so,
please.
I've had this question come up several times. So this is the business we're in. We watch this stuff all day long, every day. But for the most part, I would say that we spend the majority of our time in client meetings. So we're not staring at all the trades and what's happening every day. I mean, we do get information that comes to us, on a frequent basis, but we're not staring at it every day. And as a matter of fact, I'll get the question, well, how often do you do something, or how often do you change your portfolio, or how often do you watch it? I look at mine maybe a couple times a month, and that's about it.
Yep.
Because all my stuff is buy and hold. So I buy it, I hold it, I do monitor it, and if I like ABC widget better than I do XYZ widget, then I'll go change it out. But I don't watch it every day. I've got clients that literally watch their portfolio
and
every
that's
single day.
Exactly the point. All they're doing is stressing themselves out.
Yeah, I don't even do that. and I'm in the business.
Well, it's amazing how much more free time people have once they go to retire, right?
Yeah.
And so
Yeah, that's true.
one of their part-time jobs at that point is figuring out what their investments are doing and how much money they're making every day.
Yeah, no, that's a good point.
All right, so I'm going to go on to the next one because
Yep.
these are all kind of related. The Dow has compounded at less than 3 basis points a day since 1970. Since then, it's up more than 3,000%. Right? So what that's saying is these little daily ups that you get are very, very small, but the power of compounding interest is truly amazing. And I think it was, y'all correct me if I'm wrong, I think it was Einstein who actually said that the greatest invention of mankind is compounding interest, because it's amazing what you can do. And we've all used that little technique where you're explaining to clients that don't understand interest. Would you rather have $5 million, or would you rather have 1 penny that compounds at 100% per day for a month? And in 31 days, that's $11 million. So that's the power of compounding interest. And if you look at it over time, that's exactly what happens.
Well, I just want to clarify one thing, too,
Yeah.
because you said 3 basis points. So for those that may not know what a basis point
there you go. Yeah,
specifically
thank you.
is, a basis point is 0.03%.
Yeah.
So you're talking about just a very tiny percentage here. We're not talking about a lot. 100
small.
basis points is 1%.
It's 1%, right.
Hey,
Thank
could you that second bullet point that you just made about this compounding interest? Could you send that to my bank, because evidently they forgot the compounding interest thing? Because
Yeah,
I literally
banks don't know what compounding interest
oh my
is anymore.
God, it's unbelievable. I remember, even just a couple of years ago, just the interest in my, I have like a savings account. I was getting $15, $16, $17, $18.
Yep.
And now I literally get 48 cents or 60 some cents.
Yep.
It's like, oh, but anyway.
Well, I mean, just a few years ago, the concept of high yield savings accounts came out. So these companies that are not your traditional brick and mortars offering savings accounts that offered more. I was getting 3.1% on mine when I opened it 6 or 7 years ago. Right now I'm getting 0.5. Right, because that's what interest rates are doing based upon the discount rate from the Fed and all that stuff, and that's another
0.5
podcast,
is pretty
so.
solid.
The
Anyway,
days of 3% interest on your savings
Yeah,
account.
that's
Wow,
long gone.
Yeah,
So-
that's tough.
Okay, so the next one, the Dow has only been positive 52% of all days. The average daily return is 0.73% when it's up and negative 0.76 when it's down. So I think the big thing there is it's positive 52% of the time, so about half. So about half the time it's up and about half the time it's down. And that's where you get a good diversified portfolio. Polio, I almost said polio.
Yeah,
that would
we get
be,
it.
that's a totally different
We are
word.
struggling today.
Well, let's hope our clients aren't
I
getting
haven't had
polio.
enough
Yeah.
coffee yet. That's what it is. But that's where you have to have a good diversified portfolio to take advantage of the ups and to not take as big of a hit on the downs, because you're going to get about half and half.
Yep.
And this also goes back to what you were talking about. Almost you probably the best investors are the ones that lose the password to their online accounts.
Yeah.
So they can't check them every day.
Yeah.
That's why you don't want to check it every day, because literally half the time you go to check your accounts, they're going to be down on a daily basis.
Yep.
You have to. It's a long-term game.
That's exactly right.
So
Okay, the Dow has spent more time, 40% or more below the highs, than within 2% of the highs. I almost need the whiteboard to kind of graph that one out. We're not going to go there. 20.6% of days versus 18.4% of days. So that's a little hard to wrap your head around for me without doing it visually. But basically what it comes down to is it says here, no pain, no gain.
That's right.
Right? You're going to have a lot of down days, and you need to be patient with those. As Eric just said, long play. And then this one, I love this one, and I'm going to stop on this one. The Dow gained 38 points in the 1970s.
That's shocking.
That is stunning.
But take in perspective that 38 points relative to where
Exactly.
to where the Dow was
As
is
a
still
percentage, yeah.
as a percentage is still a decent
Exactly.
gain. But
So-
still, you think 38 points over over a 10-year period? That's
Well, but it's a percentage game, though. So, okay, right now the Dow is at 32,658. And in March of last year, we went down to, 18.9, 18.7,
pretty close, yeah,
something
yeah.
like that. So we're up 15,000 in 1 year, right? But if you think back in the 1970s, how big did the Dow go in the first place? There were not as many things going on. There wasn't as much money being invested, basic inflation. And we were talking about before the podcast, I remember when I was a sophomore in high school in 1986, 87,
You're old.
I am old, but you're 1 year older than me. So
Oh, that's right. I forgot.
yeah, I got the big one this year, and I know that's probably going to get ugly. But I remember my world history teacher talking about the markets and how they impacted history, and he said, "Did you all know that the Dow hit 2,000 today?" I remember talking about that. It was either 86 or 87 because, like I said, I was a sophomore. So if you think about it, 38 points out of 2,000 is a much bigger percentage of the entire thing than what 38 points would be today. That's nothing.
Yeah.
It's also worth noting, too, when you look at these things from a historical perspective, what else was happening in the 70s and 80s around interest rates?
Yeah, absolutely. You had super inflation. You had massive interest rates. You had 18% for a mortgage, right?
So you were paying 18, in the high teens for a mortgage, but you throw your money in a savings account and you were getting double digits on your CDs, right? Which doesn't exist today, which is why so much more money is flowing into the stock market, into equities, because you're not able to get those types of returns on your more traditional fixed income investments.
Yep. Excellent point. All right, that's everything I had. Who's next?
All right, cool. I'll go because we're just going to kind of follow in line
All right.
here. All right, so we get a lot of questions about indexing. What index should you follow? We get lots of questions around that. So this is pretty interesting. It said, why am I using the Dow instead of the S&P 500? And really, they have the same correlation. It's within like 0.95 correlation, which means they're almost identical.
Yeah.
So the only one that, and I'm gonna get to where I'll get to the answer that we normally give clients, but the Dow and the S&P are really years and years and years ago. You go back, back in the 70s, for example, that probably was a more reflective of the overall market because the Dow's 18, 19 positions, something like that.
30.
I can't remember. 30. That's
30,
right.
yeah.
30
30
positions.
positions.
That's right.
Yep.
30 positions, and the S&P has 300. Oh, that's right. No, sorry.
No, that's a different podcast from
That's a
way
different-
back when.
Yeah, that's an inside joke, by the way.
That's a very inside joke.
Yeah,
Yes.
but if you think about it, if you're only representative of the top 500 securities, you're missing out on 5,000 other positions
Yeah.
that you're not even covering. And that's not even including international. So, which index should you watch to give you a more representation of the overall market? So I'm going to let each of you give sort of what you watch, right? I mean, you can watch the Dow, the S&P, the NASDAQ. That'll pretty much get you, a pretty good reflection. But what I always tell people is look at the Wilshire 5000. That's an index, top 5,000 securities. That's pretty much, and it'll have your, big capitalization companies, small.
Yeah.
Kind of has a conglomerate of everything. So that's what I typically look at. Is the Wilshire 5000. How about you guys?
Well, that's definitely the most broad. Most of the time, I just refer to the Dow Jones because when you see the headlines, when you see the articles in the newspaper, everyone refers to the Dow, and the Dow is the overall general market. Even though, to your point, it's only 30 of the stocks, right? So it's really not nearly broad-based enough to be reflective of the market as a whole. To your point, the Wilshire, even the Russell 2000 are far more indicative of what the market as a whole is doing.
See, I think that it really depends on what you're trying to learn. The way that I learned it was the S&P 500, so the 500 biggest companies, that's kind of an indication of the overall health of the market, whereas the Dow Jones is an indication of the trend. Because all it takes, and there have been quite a few times in the last few years where you've had everybody pretty much flat except for one company, like an Apple, for example, that they're just having a banner day because of something, and the entire thing is way up. So that's the problem with that. It's a trend. It kind of shows you where the market is going. S&P is more for health. I'm with you. The Wilshire 5000, that's a much better one to look at when you're looking at everything.
Yeah, probably the reason I didn't know how many stocks from the Dow is because I don't even pay attention to the Dow. Personally, I don't even look at it. I know it's the one that's advertised the most. S&P's probably getting there more now. But I don't even look at the Dow because I just don't think it's a true reflection of the market.
couldn't even tell you specifically what all the 30 stocks are on it right now. I know
a
a few.
handful of them,
I mean,
that's about it.
I mean, you know most of them just by name recognition. But
yeah, I know they just changed out one not too long ago. And you have to meet certain requirements to stay in the Dow, and they just moved one out. I think they moved
General Electric.
General Electric out.
They fell out. Yeah, they've
they
been
fell
there
out.
since like the 40s or something.
they were a mainstay. Yeah.
Anyway, so that tells you how much we watch the Dow. So in other words, if you really want to know, maybe what you should be watching, take advice from, and look out some other indexes. All right, So this is one that was pretty interesting, I thought. That at the low in 2009, which is actually March 29th, I believe.
Yeah, I
was
think
the
that's
low,
right.
March 29th.
Well, I thought it was 2020. Oh, we talking about 2009.
Yeah,
Yeah,
2009. Yeah. I think it was March 29th. At the lows in 2009, we were essentially where we were in 1996.
Yep.
So, and one other piece that I'll say, if you go to Yahoo Finance, because that's one that's pretty generic.
It's a good one, yeah.
And at the very top, it'll say the S&P, the Dow, and then there'll be several indexes. You got gold and silver and currencies and things like that too. But if you click on the S&P 500 and then click on a chart and click max, you'll see it goes all the way back to January 1st of 1950. And you'll see the S&P 500 from that time period, 1950, all the way till today. The interesting thing is, if you go back and look at the 2000.com bubble and the 2009 real estate bubble, if you look at that, the little humps are getting a lot smaller. Yeah. So as more of this market continues to outperform, those humps are getting smaller and smaller. Yep. Now, if you go back to Monday, October, whatever it was, 1987, they call it Black Monday, I think. Black Monday. If you go back and look at it, you can't even find it. And everybody thinks, oh, that was a horrible day. And it was, by the way. Yeah. But you can't even find it on that chart.
You need a magnifying glass to see it on the chart.
Yeah, you can't even find it on the chart.
It's too small.
So with that being said, the last one I had, which is pretty interesting, I'm just going to stat and then I'm going to turn it over to Eric. But the Dow, here's what they did during the Great Depression.
Oh, yeah.
These are staggering numbers. You think, in March of 2019, we were down, or 2000, was it? Yeah. We were, or 2020.
2020,
we were down 32%.
It was right around 33, 34%, depending upon what index, but yeah.
All right. So take that in consideration. Now, we snapped back pretty hard, right? I mean, by
Extremely
April,
hard.
May, June, we were rocking and rolling right back to the top again. But if you take those statistics, take this in mind, in 1929, the Dow lost 17%. Okay. Not, terrible, but not a horrible year, right? But that was followed up by 34% in 1930. And that's 34% from that high.
Right.
So you're down 17, then you're down 34. And then in 1931, you're down 53%. That's basically cut in half.
Yeah.
I mean, it's staggering. And then in 1932, it lost another 23%. So look at those numbers. I say take that in perspective because if we have another pullback and we're down 12, 13%, it's okay.
Yeah.
Right? We don't have any numbers.
Well, we have, a 10% market correction is very, very common. Those happen almost on an annual basis.
Every 18 months.
For the most part.
Average,
and you start talking about bear market territory when you hit, when it's down 20%. But that kind of sustained drawdown over a period of 4 or 5 years, I mean, you really need to appreciate how horrible that was. I mean, how devastating that was really for our entire economy. And we talk about the American economy, for the global economy.
Yep.
It was just an awful, awful event.
Yes.
So,
all right, Eric.
Well, with that, so I had a few more things. So you mentioned gold before, and I think this was a pretty interesting stat because I don't know about you all. I've had to answer some questions about gold and trying to hedge against the market as we're starting to see some. We're back to all-time highs now, right? We were talking about that earlier, and as you enter all-time highs, people become, people are nervous when the market is dropping, but now that we're at all-time highs, people get nervous for a completely different reason. Yep. It's kind of funny. But I saw some of these stats around gold versus the stock market, and gold and the Dow were both at 800 in 1980. So today, gold is worth $1,700 an ounce. The stock market, or the Dow Jones, is near 32,000. Or actually, it's over 32,000. Yeah. So since 1980, there's no question what's been a better investment since 1980. However, over the last 20 years, gold is up 340%. Stocks are up 208%, including dividends. Yeah. You can go get advice. You can go hear stats. There's all kinds of numbers. What's the phrase? There's lies, damn lies, and statistics, right? Yeah. I can create any kind of narrative. I can create any kind of story I want to, with whatever stats that I want to use or whatever stats I have at my disposal based upon, the time frame, whatever dates I want to plug into my comparisons. So, I fielded a lot of questions about gold. We're getting a lot of this about Bitcoin right now as well. That's another hot topic. At some point, we're going to have to delve into that in a little bit more detail, but
good luck getting that through compliance.
Yeah.
Well, we have to figure out a way to
Yeah,
to
right.
do that, right?
Yeah, good luck.
No recommendations on that, by the way, one way or the other. But yeah, you just need to be careful when you see commercials on TV or you hear, quote unquote facts or statistics, things like that in the news. You want to be careful about the date ranges that you're looking at, because traditionally over the long haul, gold has not necessarily been as good of an investment as the stock market. Now that doesn't mean gold's going to have a bad year. Gold could outperform the stock market this year.
Sure.
And maybe even the year after that. So things change, different, the performance of different asset classes is going to change over the years, right? And that's why we build well-diversified portfolios, so we're not putting all of our eggs in one basket, so to speak. So another stat that I saw that was really interesting, since 1980, gold is up 153%. Inflation is up 230%.
Yeah.
So gold, though, most of the time is sold as a hedge against the stock market and a way to keep up with inflation, and that really has not traditionally been the case over the last 40 years. 1980. I'm going to date myself because I was born in 81. So you talk about your big birthday. I got a big birthday coming up this year too. So one other stat that I found really interesting: if you had invested between 1960 and 1980 and beaten the market by 5% each year, you would have had less money than if you'd invested from 1980 to 2000 and underperformed the market by 5%. So
It's
if you were one of the best investors from 60 to 80 over that 20-year time frame, you did not do nearly as well as a bad investor from 1980 to 2000. All that to say is really it's kind of funny that the best indicator of how much investment success that you're going to have over your lifetime is based upon what year you were born in.
Yeah.
How old you are.
Right.
Because you can't control the events. I mean, we talk about the Depression, right? What happened in the Depression, I mean, you can't control that. It doesn't matter how good of an investor you were. Your portfolio was destroyed, over that 4 or 5 year time frame. So a lot of all that to say is sometimes most of this stuff is just out of our hands. It's out of everyone's hands as in regards to how much your portfolio is going to perform.
It would be interesting to get that same statistic from 20 to 20, or from 2000 to 2020.
Yeah.
Right? It would be interesting to have that. Now, this was, I think, we looked at it.
2019,
this is through March of 2019.
Yeah, March.
Yeah.
So some of the statistics for 2020 are not in there, but it would be interesting to see how different investing from the year 2000 to the year 2020 would be compared to those two. And it'll be, look, over the next 20 years, it'll be even more different than the previous 3 20-year periods. It's just it's just how it works. So anyway, any other comments anybody wanted to make on any of this? And let's...
No, the one thing that I would add to it is, Eric had a great point a minute ago when he was talking about statistics. When you are looking at different statistics, you need to keep in mind what the person that's putting those statistics out is trying to accomplish, because depending on the windows of time that you use, it's really, really easy to twist things in a certain way. So just be cautious.
Yeah, I mean, I even shudder sometimes when clients or prospects ask us about our performance numbers, because there's so much that you need to put in context when you share some of those numbers that I really don't even like to talk about that too terribly much, because and plus whatever we've done going in the past can change on a dime going
Absolutely
forward.
right.
So.
Yep.
Yeah, for sure. Well, listen, we'll kind of wrap up today's shows. Remember, if you want a copy of this, it's not a sheet of paper. It's actually a link that Eric can get you. But just send us your contact information. We'll make sure to get that to you. If you want that Time magazine, it's like a trifold piece, but I actually have it electronically. I don't have it updated, but I'm sure we can get an updated version maybe through 2020. But we can get that to you. No problem at all. Just send us your contact information, and we'll make sure you get it out. Make sure you tune in every week. We do these we're doing them every couple of weeks, but we may start ramping that up if I can convince these guys to do that.
That's the beauty of a podcast.
That is right.
We do it whenever we want to do it, right?
And just so you know, right after this, we're shooting another version of our Connecting the Commonwealth, so make sure you tune in to check that out. And then we started another podcast.
A new one,
a new podcast that we're going to start this week. We've shot several. We got 6 episodes, and we're going to start to release them. It's called Burgers and Bourbon. It's really, really cool. It has nothing to do with finances, so if you don't want to hear us talk about, I don't know, estate tax and life insurance and all that stuff.
Statistics.
No statistics whatsoever. Well, no, we give. Well, anyway, you'll have to tune in to watch it. Where we review burgers, local hamburgers, and bourbon. So make sure you check that out. But anyway, we like doing this kind of stuff. Make sure you tune in. And Eric,
What's contact information?
Yeah, contact information. Or just how to. I never get that right. So what is it?
Check us out on our website, FWPpartners.com. Make sure if you're watching on YouTube, subscribe, hit the little red button there in the corner. Subscribe to our content so you'll be the first to hear about anything new that we post. Like us on social, follow us, like, subscribe, rate, review.
Perfect. Have a good week, everybody.
Thanks.
The information given herein is taken from sources at IFP Advisors, LLC, doing business as Independent Financial Partners, IFP, IFP Securities, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. This report may not be reproduced, distributed, or published by any person for any purpose without IFP's express prior written consent. Securities offered through IFP Securities, LLC, doing business as Independent Financial Partners, IFP, member of FINRA and SIPC. Investment advice offered through IFP Advisors, doing business as IFP, a registered investment advisor. IFP and Family Wealth Planning Partners are not affiliated. The information given herein is taken from sources that IFP Advisors, LLC, doing business as IFP, IFP Securities, LLC, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors.